Okay, I'm going to wait just another couple of minutes. People are starting to come into the room. And I'll tell you that I have the chat box open. I have the question and answer open. So I'm likely to repeat this, but as we go through, if you have any questions, you can post them at either place. And I will try to remember to look and keep up with your questions as I can. So we're expecting a few more, but I'm going to go ahead and get started. So you can tell that I'm not the good-looking guy whose picture's on the cover. My name is Pete Knorr. I am a vice president and financial advisor with Bogart Wealth. And I'll be covering today this topic of how do discount rates affect my ExxonMobil lump sum. If any of you are not with ExxonMobil, don't worry about that. Most of what I have to say is pretty generic, covers all situations. But there'll be a few things, and I'll try to remember to point out what might be different if you're not with ExxonMobil in terms of how these principles apply. So first, just a few words about Bogart Wealth, 3 or 4 minutes of time. We are a registered investment advisor. So in the world of financial advice, there's kind of 2 categories. There's advisors who work for a bank and those who are independent from any bank. I like to say we work for the client. So our independence means that, we're not selling mama's cooking. We're able to give you totally independent advice. We are registered with the Securities and Exchange Commission, and we have a legal duty to be a fiduciary at all times. I'll come back to the meaning of that word. We use Charles Schwab for our clients to hold their money in. So we don't hold their money, Charles Schwab does, and the clients give us a limited power of attorney to go into their account at Charles Schwab and buy and sell stuff or send money to them. We have about $1.7 billion. Well, our clients have $1.7 billion, and among about over 900 households, and most of them, says here, major oil companies. Well, ExxonMobil doesn't like us to use their name very often, so that's what that really means. Over 90% of our clients are related to ExxonMobil. We're another big oil company. So what does fiduciary mean? It means that we have to put the client interest before our own. If we have any conflicts of interest, we have to disclose those fully and then always act in good faith, being transparent, et cetera. That's what it means to be a fiduciary. And by law, we're required to be a fiduciary. We're a small company. The advisors are in the top row here. So here you can see a younger picture of me. And then we have backing us up a full-time planning team headed by Sandra, a full-time investment management team headed by Alex, and other backroom, back office folks who are dealing directly with Schwab on your behalf. We also have a tax team, so we're fully able to do tax planning, give tax advice, tax optimization strategy, and file taxes if you want us to. We have 3 locations. I don't know how convenient they are to each of you, but we started out in McLean, Virginia, just a couple of freeway exits north of Gallows Road, if that means anything to you. At some point, became aware of the fact that Gallows Road location was going to shut down. and came to Houston to see if we could attract people in Houston to want a financial advisor with a headquarters in Virginia. I worked at ExxonMobil at the time in the chemical company. I was one of the first folks who signed up as a Houston customer. And of course, in time, it became very obvious that we needed to have an office close to the Spring campus. So there we are in the Woodlands as well. Our mission statement is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. The intergenerational wealth part of it means that for a lot of our clients, their children or their parents can be big unknown factors in their financial plan. And so we're available to help their children or their parents or the client dealing with children, parents, financial issues. So we're independent. If you need an NUA analysis, we do that better than anybody in the world. In-house tax optimization and prep, I already mentioned that. You can read these on your own. Our not at all hidden agenda for doing these informational webinars is to convince you we know what we're talking about, and that if you're planning on retirement, that we can help you, and we'd like to do this one-on-one in a financial strategy session with you. No cost, no obligation. If it takes 5 sessions or 10 sessions, no cost, no obligation. So what we're doing today is part of a series that we do on retirement readiness, kind of the thing that covers all topics, but only about 1 inch deep is the retirement planning timeline. So one we've been doing the longest, and all the rest of these came from client feedback or participant feedback who said, could you dig a little deeper into this topic or that topic? So retirement income planning is probably the one that's been around the second longest. So security, tax planning, estate planning. You can see we'll get into the weeds in all these different seminars. And if you're not already signed up, later on, I'll tell you how you would sign up for these. So back to the topic for today. How do discount rates affect your lump sum? And again, if you're not with ExxonMobil, it's okay. Most of what I'm going to talk about is generic and will apply to everyone. So the first thing to understand is 2006 legislation called the Pension Protection Act actually became law in 2007 with a 5-year lead-in period. But this divides the world into 2 groups. Those who are grandfathered from the Pension Protection Act of 2006 and those who are covered under the Pension Protection Act of 2006. So one of the things that it does is limits companies who are offering the lump sum option. So for example, it says if you're not at least 80% funded in your pension plan, you cannot offer 100% lump sum. You can offer at most a 50% lump sum. And if you're not at least 60% funded in your pension plan, you can't offer a lump sum at all. So ExxonMobil strives to stay really close to that 100% funding of their pension plan, because you can bet the executives really like having that lump sum option and don't want it compromised. The Act defines what discount rates can be used. So I'm going to talk about which rates apply to you if you're grandfathered and which rates apply to you if you're not grandfathered. It defines the actuarial table to be used, so more on that. It defines some other things like non-spousal beneficiaries could do rollovers and that after-tax balances can roll over to a Roth. These are much more pertinent to some of the other seminars. I'm not really going to talk much about that. The company match can be diversified. So some of you, many of you might remember that in order to get the 7% match at ExxonMobil, you had to put all of that match into ExxonMobil stock. Some people still think that's the case, but it has not been the case since 2007. So that company match now, you're going to get the 7%, whether you put it on the company stock or not. And, you know, although there are always contribution limits, it set the law that allows those to be a little bit more predictable. So who's grandfather? I remember that this happened in 2007 and had a 5-year period of time before everyone had to be under it. So 5 years of phasing into the Pension Protection Act of 2006. So the words that ExxonMobil gave is those who are over 50 by the end of 2007. And I say, well, that means you'd be 55 by the end of 2012, the last year that the company had before everyone had to be covered, and had more than 10 years of service before January 1st, 2008, which again would mean you had 15 years by the end of 2012, then your grandfather, okay? Now, the only reason why they said it this more complicated way than the simpler way of 55 and 15 by December 31st, 2012, is because it takes into account the fact that, well, if you didn't have 10 years, let's say you only had 9, but that you left and came back and could still get the 15, and you didn't count. Okay, so they only wanted people who had continuous service up until 2012. So for those people, and by the way, another easy way to think about it is if you were born before 58 and hired before 98 and have no gap in service, then you're grandfather. Well, okay, so those people are well over 60 today, right? In that case, you're still using the old rules, which is 95% of the 30-year Treasury bond. And for those who like to look up numbers themselves, there's the link for you. And then rounded to the closest 1/4%. The other thing is they're not allowed to update the mortality table. So the last mortality table that they had that was totally consistent and in use was the 2000 mortality table. Well, life expectancy for people in their retired age up until 2020, we'll come back to that, has gone up, okay? So Treasury bond rates are lower than what the people who are not grandfathered have to use. And part of that is made up for the fact that, well, yeah, but we get to say they're going to live longer. Okay, so that's the grandfather, folks. And so this gives you a view of the 30-year Treasury bond and what it's done over the last 40 years. So going back to 1980, we had very high rates. A, because of inflation, and B, because of the Federal Reserve really trying to put the brakes on inflation and jacking interest rates way up. And then when they weren't sure that worked, they did it again. Okay, so we had a double dip recession in the early 80s. We had a magazine article, I remember in Business Week, that said death of equities, ? Okay. And since then, we've had ups and downs, but for sure, down, 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 down. So I retired in this time period here, and it was the lowest interest rates in history. And then they popped back up, and people asked me, will we ever see those rates again? And I said, well, I don't think so. And of course, I was wrong. We've seen lower rates and much lower rates. And then they popped up here back in February, March, and they've moderated a bit since then. Again, this just applies to the people who are grandfathered, so born before 58, hired before 98, but it's good background. And so another part of that background is that the data say the current quarter is what applies to the first quarter. So there's always going to be one dead quarter in between, so that you've got a good 3 months to decide, am I going to take this deal or am I going to wait? So there's always one dead quarter in between. And so then you take that 30-year treasury bond, the weighted average, 95% of it, and round it up or down to the nearest 0.25%. All right. This is what's actually happening this quarter. So you can see it started out the beginning of July at over 2%, and it went down. And at this point, we would say, okay, at this point, it was looking like a 2% interest rate. At this point, it dropped down to what we're now saying, the 1.75. And you can see it popped back up for a little bit. And we were thinking, it's going to go back up above 2, but it's moderated. Okay, this allows us to get really, really specific and say things like, so we think it's going to be 1.75. In order for it to get to 2, it's going to have to average more than 2.02. And for every day that it's below 2.02, well, it's going to have to be even higher than that. And there's 29 market days left. And I think I was smart enough to exclude Labor Day out of that. To get down to 1.5, it's going to have to get below 1.44. This is my probability of those things happening based on the volatility of the treasury bond. So I'm saying there's a 14% chance that it'll end up at 2, and there's no chance, less than 1% chance that it's going to get down to 1.5. So that's for the grandfathered folks, for any of you that might be in the room. Everybody else, and I assume that's most of you, you're going to be subject to the Pension Protection Act of 2006. So that basically means that at the end of 2007, you are not yet 50, or you're older than that, but you were hired after 1997. So you wouldn't have had the 10 years by the end of 2007, and you wouldn't have the 15 years by the end of 2012. So instead of something as simple as what I just described, it gets a lot more complicated. We use these 3, what they call segmented rates, more about what that means coming, and they're based on high quality corporate bond yield. So that's called the high quality market, and published by the IRS. Well, the yield that a bond has to pay is related to the perceived risk of whoever issued that bond. And the perceived risk of the US government going bankrupt is really, really low. You'd say, not the way they're spending. Yes, but remember, they own the printing press, so they can print more money anytime they want. So very low probability that the US government would ever default on a bond. Relative to a corporation, which cannot print its own money, and therefore they have a higher risk. Even these high quality companies, things can happen, right? For example, ExxonMobil itself is a AA rated, so a high quality company. But there were some people who questioned whether it would survive a year ago. So, okay. so that means their yields are higher, and higher yields are bad. So we call it a discount rate. And normally you think, I like big discounts, okay? But that's because you're the buyer. And in this case, you don't like big discounts. You're not the buyer of the lump sum. You're the owner of the lump sum, and the owner of the store doesn't really like the big discounts like you, the buyer, does. Okay, so bigger discounts are worse for you. And they have to use the IRS mortality tables. Now, these are released annually, but the company only has to change every 10 years, or they can't use one that's more than 10 years old, let's put it that way. The last time the company changed the mortality table was 2018. And so they're not required to use a new mortality table until 2028. And by the way, we haven't seen a new mortality table that includes 2020 data yet. So you don't have that to worry about yet. But at some point, that 2020 data is going to come in. And what do we know? We know that COVID was much more deadly, 4 times deadlier for an 85-year-old than a 65-year-old. And so that's going to limit life expectancies, unless, of course, you take the position that, well, all those people probably were going to die anyway. And so if you average that out over a few years, you should have less deaths as soon as this darn pandemic is over with. So anyway, we'll see how new mortality tables affect this going forward. But so far, it's all good news for you. And again, this first affected people after 2012. And at this point, almost everybody we talk to is in this all other, not grandfathered category. So I'll remind you that the chat box is open, the Q&A is open. So if I'm going too fast, tell me to slow down. If you have any questions, fire away, but I haven't really gotten into the main part yet, have I? So this is what those 3 segments look like. So segment 1 is relatively short-term bonds. It's between 0 and 5-year corporate bonds, high-quality corporate bonds. Segment 2, sort of intermediate-term bond. So they're longer than 5 years, up to 20-year bonds. And so you can see significantly higher discount rates. And then segment 3 is the average of everything above 20. Well, 20 to 60, although it hardly matters at that rate. You can see that the intermediate to the long term is not nearly as big a gap as the short to the intermediate term. Now, what I'm showing here in the lines are the actual data that is released by the IRS. And then the squares are our models. So any place you can see some daylight between the squares and the lines, it means I messed that one up. And you can see, at least I'm getting the direction the same. I'm just off by a little bit in terms of my predictions versus what finally got published. Here, I said it was going down and they said it was going up, and I'm still scratching my head over how'd they come up with that. So what the government is publishing here is not real data. I'm basing my predictions off of real data, and they've got all these statistical rules that they need to abide by. And I'm sure those rules make a lot of sense, but sometimes the markets go in a different direction than their statistical rules make it. So anyway, one time in history, I got the direction wrong. All right. In short, we're usually pretty close. And as far as I know, we're the only people in the world who try to predict what is going to get published by the government. Most people are just happy to wait and see what happens. So here you can see some history, and I'll show you longer history in just a minute of what these three segments do. And they're not always moving in the same direction or by the same amount. So there are times when, for example, here, segment 1 looks like it's going up, whereas segment 2 and 3 look like they're going down. And so it's hard for people to know very quickly, well, does that mean next quarter is better or worse? So we calculate this single equivalent rate, which I'm going to explain in a lot more detail in a couple of slides, to make it easier for you to see that, okay, so from third quarter to fourth quarter, no real change for a 60-year-old, but there may be a small change for a 55-year-old. And obviously you ask the question, well, why would that be different? And I'm obviously going to answer that question in just a couple of slides. So it makes it easier to compare like third quarter versus second quarter. So this is why there were so many people in a rush to leave June 1st. June 1st was the last day they could get the second quarter rate and avoid an increase of 42 or 43 basis points, which then begs the question of, well, how important is 42 or 43 basis points? So we're going to get there in just a minute. Whereas fourth quarter versus the third quarter looks like it's no change to potentially a little bit better for you. And waiting to the first quarter, of course, we don't know that one yet. That's just projected. But waiting for the first quarter next year looks like, well, that's, if this was really, really good, then, you know, or really, really bad, I guess I should say, then this is only really good. So it's half of whatever that other one was. Okay. So this is that long history view of the single equivalent rate. And you see the same kind of trend, that it's been down, down, down since the 80s, kind of lined out here between 2010 and the beginning of the pandemic. In fact, it was going up. That's 2018, the Federal Reserve raising interest rates. Coming back down, the Federal Reserve took the foot off the accelerator and the market said, you know, we don't really think it should be that high. And it was coming down. And it was coming down already before the pandemic. Coming down already before the pandemic. And then we have the pandemic and all-time lows. I'm fond of saying when Christ threw the money changers out of the temple, they had a lot higher interest rates. Okay, you see this pop up here in February, March this year. So this is that first sort of panic over 5% inflation, and it's sort of subsided a bit. So this jump up is what caused that increase in discount rates between June and July. And this phasing back down is what has us saying at this point that it looks like first quarter will be lower than fourth quarter. Okay. Now, back to what this was supposed to be about, which is, okay, but how does this affect my lump sum? So let me start with the very last line on this slide, which says this is a simplified example to illustrate the impact of age, life expectancy, and interest rates. So this is not going to get you the answer to the penny. And if you look at how many significant figures there is in $1 million lump sum to get to agree to the penny, then you would recognize that in order to agree with exactly what ExxonMobil is saying your number is going to be to the penny, you've got to be using the right number of significant figures everywhere along the calculation chain, okay? So this is really good for understanding what's going on, but it's not going to get you to agree to the penny. And If you want to talk about how to get closer to it, we can do that one-on-one. It's not really for a general audience. So, okay, this is a scenario of somebody who's going to retire in the fourth quarter at age 60. I'll do 55 in a minute. And so we know for the fourth quarter that segment 1's 0.62%, segment 2, 0.277, segment 3, 3.43. So I built this little table that says, okay, for the year in which they're 60, let's say they have an annuity of $4,797.14, which gives us $57,566 a year. And I will admit, I back calculated those to contrive an exact $1 million lump sum for this person, okay? So every year from now until when we figure they're gonna die, which in this example, they're gonna die on their 84th birthday, okay? So they're gonna receive these payments through their 83rd year, and then they stop, okay? For the first 5 years, we're using segment 1. For the next 15 years, we're using segment 2. And for everything after 20 years, we're using segment 3. And if the way you're used to calculating a discount factor is you do it 1 year at a time, that's going to work for the first 5 years, okay? And obviously, to more significant figures, it's not really the same number twice in a row, but close enough. But then you're going to see this one jumps by way more than 2.77% additional discount. So the way to understand this is, let's just focus on this year 6. The question is, how much money do I need to invest today for 6 years at a guaranteed return of 2.77% in order to have $57,566 to pay out to them in year 6. And so that would be 1 divided by 1 plus 2.77% raised to the 6th power. That's how much money I need to invest today at 2.77% for 6 years to have 57,566. So in other words, you cannot calculate the discount factor 1 year at a time using the discount factor before it and then one more discount. You're gonna have to use that power law, whether you like it or not. Another thing to point out is we're getting out here, every year is worth less than half. All right, we'll come back to that later. And I get a single rate equivalent of 2.77, which in this case happens to be exactly segment 2. It doesn't always work out that way. What I would say is segment 2 is always a good first guess at what the single equivalent rate is going to be. But let's come back to how we do the single equivalent rate a couple of slides hence. First, I want to compare age 60 to age 55. So what happens if you retire at 55 and you take the benefit right away? So you don't have to take it right away. We'll come back to that. But if you do, then you know that your annuity is only going to be 75% of what it would have been at age 60. Okay? So they're getting 75% of that $47.97 a month, which gives them only $43,000 a month versus the $57.5. Okay, I don't mean a month, I mean a year. $43,000 a year. So we put that lower number here, and what I want to point out is that this is not only 75% of $1 million. That'd only be 750,000. Okay, it's higher than that. Why is it higher than that? It's higher than that because we got 5 more years of it. So even though the annuity is only 75% of what it would be if you waited till 60, the lump sum reduction is less because you're getting less money, but 4 more years, okay? Okay, so that's 5 additional years out of what over here was 24 years. 5 additional years out of 24 years, that's almost 20% more years of income. 20% more years. But those years came at the end that were highly discounted. And I know you say, no, they didn't. They came at the beginning when I was younger. Well, yeah, okay, you're right. But on this table of calculations, you've got additional years at the bottom of the table, and those years are not worth as much as the early years. Okay. And so that's why it's not 20% difference, which would mean you'd get $950,000, but it's 15, 16% instead of the 25%. Okay. The main thing I want you to know and remember is that you think in terms of it's 5% a year discount off of your pension if you take the benefit before age 60. You're right if you think of it as an annuity. But if you think of it as a lump sum, it's not 5%. It's less than 5%. And the reason that's important is because interest rates matter. And so we're going to come back to how much do interest rates matter and how much of an interest rate change would it take to overcome the benefit of waiting for the lump sum. Okay. So that's the big takeaway from that slide. Now let's kind of change gears and talk about, so how do we calculate the single equivalent rate? So there's 2 ways to do it in Excel. So one way is you would generate, we're back to the age 60 example, by the way. One way is you would generate a table like this. How much is the lump sum today versus how much is the annuity over time? And then you would use this formula, internal rate of return, IRR. And here for the formula, you give it this full range, and it's going to spit out the answer, as in this case, 2.77. The other way you would do it is you would replace what we had before, the 3 segments, with one number, and then have all of these equal to that first number. And you would use goal seek. So it's under the data section of the ribbon, what if, under what if goal seek, and say, force this back to $1 million by changing this interest rate and all the rest of them. And so it'll do that and come up with 2.77. It's going to give you the same answer, whether you like using the internal rate of return or whether you like using the present value. Okay. So why is it going to be different? Why is the internal rate of return or that single equivalent rate going to be different for 55 and 60? Well, back here at 60, we had only 4 years exposed to segment 3, the highest, always the highest interest rate. And here we had another 5 years. So instead of 4, it becomes 9 years that are exposed to that segment 3. So when we go back to this table and we're comparing, 55 single equivalent rate is always higher than the 60, the age 60 equivalent rate, okay? Because more exposure to segment 3. Well, I haven't lost anybody yet. That's good. Okay, now to what we said we were going to talk about at the beginning, which is, well, how does interest rate affect my lump sum? Well, you can see how to work it out in the table, but most people want, give me a simpler answer than that. So I'm going to give you the simple answer. The simple answer is a 1% change in interest rate is a 10% change in lump sum. That's just a rule of thumb. It's not precise, but it's pretty darn good. And 0.5% would be 5% change in lump sum. Pretty linear within that 0 to 5%. So let's look at where I worked out in detail started with a retirement in the fourth quarter, giving you a lump sum of $1 million, and then either decrease the interest rate. I know, hard to believe, but we think the first quarter will be lower than the fourth quarter. So a 1% decline, now if we had a 1% decline, we'd have negative here, but okay, a little weird. But still, a 1% decline gives you another $100,000. Okay, 110 out of $1 million. So that's 11%. That's pretty close to my rule of thumb. 0.5% change is about half of that, right? 0.25% change, 2.6%. Increasing goes the opposite direction. So increasing the discount rate by 1%, you're going to lose 9.5, call it 10. If it rate goes up by 0.5%, you're going to lose 4.9, call it 5. So that's the simple way to think about how interest rates, a change in interest rate is going to affect your lump sum. The first thing to do is say, well, I need a single equivalent rate. And if you don't want to calculate it yourself or get it from us, your closest approximation is going to be it's segment 2. Not always going to be right, but it's your first approximation. And look how much segment 2 changed from quarter to quarter. Or you can do the internal rate of return, single equivalent rate. You can get it from us and compare one to the other, see how much has it changed, and apply the 1% rule of thumb. Or you can have us run the numbers for you. Okay. I mentioned before that a person can retire, well, now or whenever, and delay taking their pension. They can delay the annuity, they can delay the lump sum. How long can they delay? Well, until age 72 or death. Okay, so when would you consider delaying the pension? Well, number one, you got to have some other money to live on. Some people do, most people don't. But if you do, then okay, you might consider it. Particularly if you're retiring before age 60, where you know that there's that 5% per year haircut if you take the benefit before age 60. So the annuity is going to go up 5% a year if you wait. If you can afford to wait, that might be a good deal for you. The lump sum is going to go up about 3% a year. So I did the 55 versus 60 comparison. I showed you it's not really only 75% of the lump sum. It was 84% of the lump sum. That's about 3% a year instead of 5% a year. So now you have to think about, are interest rates going up or down? So what we would generally tell somebody who's retiring before age 60 and taking the lump sum to wait and see what interest rates do. And as long as they're flat or going down, just keep waiting. If they jump up, okay. So jump up by how much? Well, I'm saying the lump sum is 3% a year, not 5%. And how much of an increase would it take to knock out 3% or having waited a whole year? And, you know, the answer's got to be somewhere around 30 basis points. 0.3% change in interest rate would be a 3% change in the lump sum. So again, if you're in that situation, really happy to run numbers just for you and show you what it means just for you and whether or not delaying the pension can work for you and what are your options, where's your money going to come from while you're waiting for the pension. Okay, so for someone who's thinking about retiring in the fourth quarter, I would tell them, think about January 1. So you can still leave in the fourth quarter, third or fourth quarter, and delay the lump sum until January 2022. But this roadmap is for someone who actually wants the benefit in January in January of 2022. I like this version of it better, by the way. This is sort of the colorful artist version, and this is the engineer's more detailed version. So basically, the company says, ask for the intent to retire package 90 to 120 days in advance. So 190 days in advance is like plenty of time for the check to show up on time. But for those who really like to get things done early, they won't allow you to request it more than 120 days in advance. So you will request the intent to retire package from the benefits office, and at about the same time, you ought to be informing your supervisor in writing, doesn't have to be formal, email's good, of what is going to be your last day on the payroll, your first day of retirement, and your benefit commencement date. You know, we just made these numbers up, but keep in mind that you need to be on the payroll the last day of the year in order for any incentive awards for those of you who get those things, if they're given this year, which they weren't last year, but to actually receive incentive awards, you need to be on the payroll on the 31st. To get your vacation for 2022, you do not have to be on the payroll December 31st. It can be December 30th. And I would say it really doesn't matter unless you're a grandfathered from the Pension Protection Act, then it matters and we should talk. But if not, I would just go ahead and make December 31st my last day on the payroll, first day of retirement, January 1st, benefit commencement date can be the same day, January 1st. Okay, you're going to get your intent to retire package. It used to take 4 to 7 weeks, 4 if you did not have a quadro, 7 if you do have a quadro. What's a quadro? If you've been divorced and your ex has a chain around your pension plan, that's called a qualified domestic relations order, or quadro. Okay. That used to take that long. It doesn't take that long anymore. They figured out how to take a whole lot of nonsense out of the process, and they can get those intent to retire package out within days, sometimes within 1 day. So it doesn't take that long anymore. But the key thing is that you have to return the forms, notarized, complete, no errors, 35 days prior to the benefit commencement date. So if you want the check to show up on January 1st, you have to have the notarized forms back to them before Thanksgiving. Okay? 35 days in advance. 30 of that is federal law. 5 days is ExxonMobil belt and suspenders, or to be a little kinder, to say that if there's some minor thing and it can be fixed within those 5 days, you still have met the 30-day requirement for the US government. I can say I had one of those because I did not let my financial advisor review the package with me before I sent it in, my error. And it took me more than 5 days to fix it. So my check was a month late. They only issue the checks on the first day of the month. Okay, so this is that roadmap. So what do you do now? Well, the first thing is have a plan. And the most important part of the plan is your spending budget. And, you know, so understand your cash flow needs and what do you think your expenses are going to be in retirement. And most people spend more in their first few years than they thought they would. They have more time to think. they realize they're not going to be young forever. They decide they ought to go out and start doing those things on their bucket list. So understand those things and it'll improve your plan, okay? And then also understand how much risk you're willing to take in investment markets. That way we can work with you better on to how do you set up your assets to create that cash flow so that you can afford your budget. Okay. So I said early on that I would tell you how to sign up for knowing about these in the future. The way you do that is, if you'd like URLs, you just go to Bogart Wealth video events. If not, you go to bogartwealth.com and you click on resources, and then under that, events, and then there's live events or video events. You go to the video events page and you sign up here. And I want to point out that we're not even asking for a phone number. So nobody's going to call you and pester you. And if you find that we're annoying to you, you can just block our emails in the future. But that way, you'll get notifications of future events. So you can see, you know, we do backdoor Roth and after-tax rollovers. I mentioned Social Security. What if retirement comes earlier than expected? Retirement income planning. And we do this seminar every month, like clockwork. When the IRS publishes new numbers, we update everything and do it again. Another way you could do it, and particularly I mentioned earlier that how would you get those single equivalent rates? And I said, well, you can get them from us. Well, you don't have to call us for them. You can get on our mailing list that every week we're going to update these numbers with our latest forecast of what's coming. And so the way to do that is you would go to the contact us part of bogartwealth.com, and in your message, you just say, just sign me up for the weekly emails on interest rates. Here we do ask for a phone number, but trust me, nobody's going to call you if that's all you ask for. We're going to call you if you ask us to, oh, and call me. Okay. So don't worry about signing up for these things. We're really not, you know, in the habit of bugging people that really just wanted information. It's just not what we do. But again, our not at all hidden agenda is that we would love to talk to you some more one-on-one and show you how these numbers affect you, and you know how to work with the different sorts of issues that changing interest rates are going to create. All right, I got no questions today, so I either did a really good job or everybody went to sleep. This is contact information for me or any of the other advisors that you want to write to and ask a question about this. I will hang on for another few minutes in case any other questions come up. Thank you for attending and hope to see you at a future webinar.